The second portion of this chapter discusses receivables. Receivables are closely tied to revenue because accounts receivables are created when sellers recognize revenue associated with the credit sale, which typically happens when the performance obligation is completed. They recognize a revenue with a related receivable when the sale is done on credit. And most businesses provide credit to their customers because typically it's either not practical to require immediate cash payment, or they want to do it to encourage customers to purchase more of their products and services. So they'll offer you credit in order to make that purchase now or to incentivize you to purchase more. Accounts receivables represent informal credit arrangements that are supported by an invoice rather than notes receivable who are formalized and supported by a contract. Accounts receivable are typically due within 30 to 60 days, and that classifies them as current assets because remember, current is defined as the year, 12 months, or an operating cycle, whichever is longer. And even if the operating cycle is longer than a year, accounts receivable are typically due within that operating cycle. Remember, the period is 30 to 60 days, and so typically they're classified as current assets. As stated a moment ago, accounts receivable is closely tied to revenue recognition. And remember, from our previous chapter, we recognize revenue an amount that's equal to the amount we're entitled to receive in exchange for providing goods and services, in other words, completing the performance obligation. We allocate the transaction price of the overall contract for revenue to the various performance obligations that exist within the contract. And so you can see that if we're recognizing revenue as a credit side, so this is our credit portion, our debit side, when this is done as a credit sale, is going to be accounts receivable. So we talk about the recognition of revenue because it represents the other side of the journal entry, which would be accounts receivable, and therefore help us value accounts receivable. Now, because revenue recognition and accounts receivable are very closely tied, we deal with the complexities from revenue recognition with accounts receivable as well. Two of those issues are time value of money and variable consideration. Because credit sales allow a customer to get goods or services now but pay for them in the future, you can think of a credit sale as providing a loan in addition to whatever goods and services are included in the contract. So because we're providing this loan, we essentially have a financing component to the loan. In other words, an interest component to the loan, which is where this consideration of time value of money comes into play. However, because accounts receivable typically are collected within 30 to 60 days, accounting rules allow us to ignore the financing component if it's not material to the financial statements. And so because it's collected within 30 to 60 days, typically the financing component is not material, and therefore most companies will simply recognize revenue at the original amount or the entire amount without taking into consideration the time value of money aspect. But that's where it theoretically comes from. Another type of consideration, though, or complexity, is variable considerations. And remember, variable considerations are dependent upon some sort of future event taking place. And here we do have to consider some potential components like discounts that might exist or sales returns that might exist that are dependent upon a future event to consider what amount we truly have the right to receive. The first type of variable consideration that we'll consider are discounts. There are two types of discounts that we'll look at: trade discounts and cash discounts. Trade discounts are not considered variable consideration. Trade discounts represent a percentage reduction from a list price, or perhaps quantity discounts for customers that buy a whole lot or maybe are important because they want to have their goods in their stores. But trade discounts represent simply a way to specify a transaction price. They entice individuals to purchase certain goods without actually publishing the discounted price that they may be willing to offer. They're not variable consideration because they're not dependent upon a future event. Instead, they are simply a way to recognize a transaction price. Cash discounts are variable consideration because cash discounts are dependent upon whether or not an individual pays within a certain period of time. So cash discounts represent reductions in the amount to be paid by the credit customer if paid within a specified period of time. And so this provides an incentive for quick payment, but whether or not they get that discount is dependent upon the action that they take. So we're not for sure what the transaction price is. It's dependent upon a future event, therefore it's variable consideration. Oftentimes we describe these terms, these cash discount terms, like 210 net 30, which means again that we have a 2% discount if paid within 10 days, otherwise full payments required within 30 days. We have two methods in how we can handle the cash discounts. Remember, we don't know whether or not an individual is going to pay within the discount period, and so we have to come up with an accounting method to take into consideration that future event. The two methods that we are allowed to use are gross method and net method. We have an example that says Hawthorne Manufacturing Company offers credit customers a 2% cash discount if sales price is paid within 10 days. Any amounts not paid within 10 days are due in 30 days. These repayment terms are then 210 net 30. On October 5th, 2018, Hawthorne sold merchandise at a price of $20,000. Customer paid $13,720, the original $14,000 less the 2% cash discount on October 14th, and the remaining balance was paid of $6,000 on November 4th. Okay, two methods in which we can handle this. The first one is the gross method. And again, we're not going to get creative with our names in accounting. The gross method means we're going to record it at the gross amount, the original amount. So our original sales price that we had here was $20,000. The gross method records the original accounts receivable at $20,000. And it only adjusts in the future if the discount is taken. The net method, on the other hand, assumes that the discount will be taken. And there's a theoretical reason for this that I'll show you here in a little bit. But the net method records the accounts receivable assuming that the customer is going to take advantage of all the discounts offered. Therefore, it takes $20,000 and multiplies by 98%, which is 100% minus the 2% discount. Now we consider the first payment that was made. Remember, they pay part, the $14,000, on October 14th. So the gross method will record cash at the amount that's received, but remember, it had accounts receivable at the gross value, so it has to get rid of all $14,000. But the customer didn't use all $14,000 to settle the $14,000 owed. Instead, it only paid $13,720. This difference is recorded into sales discount. A sales discount account represents a contra revenue account that is deducted from sales revenue to arrive at net sales. The net method instead just simply debits cash and credits accounts receivable for the $13,720. Because remember, the net method assumed that the customer would take advantage of all of the discounts available. On the next payment that we have, for the remaining balance of $6,000, the gross method will simply record debit to cash and credit to accounts receivable for the full $6,000 because they assume that the customer wasn't going to take advantage of the discount. However, the net method has to make a modification. It receives cash of $6,000 but didn't expect to receive that $6,000. Instead, it only expected to receive $5,880 because it thought the customer would take advantage of the sales discounts. We would create a new account, which is an adjunct revenue account. It increases revenue, and it sort of serves like an interest revenue account, and we call that sales discounts forfeited. And essentially what that represents is that financing component, so to speak, for the discount that's been not taken by the customer. Notice that both methods arrive at the same result. Both methods account for only the discounts that were taken. It's just how we go about the accounting to get there is slightly different, but both methods will arrive at the exact same result. Now, in terms of the theoretical basis for why it is that we have the net method, and in terms of that financing component that I was talking about for the cash discount, so to speak, think about the consideration of what the discount actually represents. Let's take the scenario here where we have terms again, 210 net 30. So what this indicates is that if we pay within 10 days, we receive a 2% discount, but everything must be paid within 30 days. The time difference between here is essentially 20 days. So what we're saying here is that you must pay 20 days earlier in order to get a 2% discount. Let's pretend like the gross amount was $100 to make it nice and sort of round. So if we pay 20 days earlier than what we're actually required to pay, we will get a 2% discount. In other words, we save $2 if we pay within 20 days and only have to pay $98. Now notice, if we take this $2 and divide by 98, the amount that we had to pay, that produces for us a 2.04% return. And remember, this is for a 20-day period because we're only paying 20 days earlier than when we're required to pay. Remember that if that's the case, this isn't just a 2% return that we're getting for a $98 investment. Remember, we're paying $98 now at the end of 10 days instead of $100 at the end of 30 days to get a 2% return or $2 discount. That represents a 2.04%, but only for 20 days. If we want to calculate the yearly return, we'd have to extrapolate that over 365 days. In other words, we take 365 and divide by 20 to see how many 20-day periods are in a year, a given year of time, and then multiply that by the 2.04%. And that provides us our annual effective rate, which is 37%. So understand the theoretical basis now for the net method. It assumes that all rational customers will take advantage of this discount because it represents a 37% return on their investment of money. With that being said, both methods, the gross method and the net method, are used in practice. Either one is acceptable. Therefore, we teach you both here. But I at least want you to understand the theoretical reasoning behind why the net method is technically probably the preferred method.